Take a look at the markets. Futures pointing to a higher opening this morning after the Federal Reserve finally ended nearly a decade of zero rates, hiking the interest rate by 1/4 point. Joining the conversation right now, Federated Investors Chief Equity Strategist, Phil Orlando, and Wall Street Journal Chief Economics Correspondent John Hilsrenrath. Good to see you, gentlemen. Thank you so much for joining us.
Thanks.
John,
Thanks
I'm going to get to you in a second because I know you predicted it. They're going to raise. They're going to raise. You were on the air yesterday. What's your take on this, Phil Orlando?
We were in the 1/4 point hike camp, so we're fine with that. We also thought that the market response, the equity market response, would be that stocks would rip. With the market at 2,000 at the beginning of the week, we felt that a move up to 2,200 was possible. We've gotten 4% of that here in the first 3 days of the week, so we think the market could continue to grind higher over the next couple of weeks.
Why? Why did the market rip on the news?
Well, because I think investors, they were fearful of the Fed hiking for the first time in 9 years, and finally cooler heads prevailed, and they said, well, wait a second. If the Fed is tightening policy, doesn't that mean that they're finally confident enough that the U.S. economy is healing, that it can walk without this extraordinary accommodation? And I think at that point they started to price in better things.
Well, on the economy healing, let me bring in John Hilsrenrath and just say, John, I want to ask you this question, but you know I've got the utmost respect for you. And I just want to ask you.
Sounds like there's that's
always a sign of trouble. Let's hear it. Let's hear it.
John, you know I have tremendous respect for everything you do. But Roy Neuberger, the legendary investor, used to say, we don't have an economist at Neuberger Berman because if we have an economist, we're going to have to pay the economist, and then we'll probably want to listen to the economist. Why should anybody, when you reflect back at the last 5 years, and they did raise rates, and they did it based on an economic forecast, think that the Fed is going to get it right this time, when they haven't predicted any recession in the last 30 years?
I think that's a perfectly legitimate question. I mean, the Fed has gotten a lot of its forecasts wrong in this expansion. You know, they thought that inflation was going to come back, and it didn't. They thought growth was going to be stronger every year than it has been. So I think that's a totally legitimate. You know, there's a perception in the market sometimes that the Fed knows more than the market knows. And, you know, I think the lesson of the last decade is that we're all kind of walking around in the dark.
Yeah.
Is the problem that they talk to all, they're basically an inbred group of buddies, and they all talk to one another, and people in the academic world, and they don't talk to enough people on the outside who have dissenting opinions. The point being, there was not one dissent in that decision yesterday, right, John?
Yeah, so I'll make 2 points about that, Dagan. One is I like this phrase about inbred that you used.
Well, you know, I mean, that's from my people.
They are mostly PhD economists, but they've got a problem because when they talk to guys on Wall Street, then they get attacked for being too close and too cozy to Wall Street and giving away inside information.
Richard Fisher always was in touch with business people, and it made him smarter. It made him more in touch with what was going on, and that's why he always had the right call. Richard Fisher was the president of the Dallas Federal Reserve, right? I mean, he was always in touch.
They probably need more people like that with non-PhD. But Maria, can I make one other point about Dagan talked about how Yellen got a unanimous decision. I think Janet Yellen is the big winner today. You know, she had a great December and a terrible September. You know, we got good jobs numbers. She went into this thinking that she could get some dissents from people working right down the hall from her. She got everybody on board, and the market rallied. You know, it was telegraphed pretty well. And this was after they really fumbled the way they handled things in September. There was a lot of confusion when they didn't move. And, you know, she was kind of not talking for literally 2 months at a time. You know, I think she walks out of this experience with a stronger hand.
Guys, can we talk about 2016 for a second? Because what's most important right now is what the next year looks like in terms of Federal Reserve increases, isn't it? I mean, it was pretty indicative yesterday by her commentary and her move that they're going to be gradual.
Right.
So what does 2016 look like in terms of interest rate increases, and how impactful is it? How many are you expecting?
We agree with the Fed that this pace will be gradual. We're expecting 3 more 1/4 point hikes next year at the first 3 pressers.
So you're talking about 1% by the end of next year.
1% by the end of September. We think the Fed then pauses. How does the market and the economy respond? And I think they want to leave a little room for the election in November.
Phil, you said that stocks ripped yesterday after the announcement because the Fed is saying they believe in the economy.
Right.
John just agreed that, you know, they're taking a guess. Everybody's taking a guess. I see the way the industrials trade. I look at many of the energy stocks. I look at what's happened with a lot of the companies that have been great total return stocks paying dividends. And they're saying we're going to hit a recession next year.
No.
So who's got it wrong?
But we're absolutely not in the recession camp. We think
industrial sector of the economy.
Well, the industrial sector.
So you would think the industrials are the most attractive area in the stock market then, because they're trading as though they're going to be.
If I'm looking out, if I'm taking a one-year view, I would say that energy and industrial stocks right in here are very cheap. Now we may not see them bottom until the first half of next year. There may be some more weakness, but we think there's going to be a turn, and that's part of our thought process.
And you don't think that just because the industrial side of the economy is in recession, that the rest of the economy goes into recession?
Well, that industrial piece is about 15% of the economy. Now, energy has the collapse in energy, and crude prices are down by 2/3 over the last 2 years. That's cost about 75% of the miss to earnings that we've seen over that period of time. The strength in the dollar, about 15%. We happen to think that energy prices are bottoming in here. We think that dollar strength is probably topping. If that's right, the headwinds from those ought to recede over the course of calendar 16.